Speaking of money, it's time for the business news now with Charles Pellegrin. Hi, Charles.
Hi, Karis.
You're starting off with the price of oil moving back up a day after that ceasefire was announced by Donald Trump.
A ceasefire that seems incredibly fragile as Israel launched missile strikes against Lebanon-based and Iran-backed Hezbollah on Wednesday, and as traffic through the Strait of Hormuz does not appear to have meaningfully changed from before the ceasefire was announced, suggesting Iran is only letting a handful of ships through. That and the fact that Iran's parliamentary speaker has accused the U.S. of being in breach of the agreement. The barrel Brent and West Texas Intermediate moving slowly back up throughout this session towards that $100 a barrel mark. And in a very familiar pattern to all of us now, we're seeing trading on the major European stock markets lower as a result. Here's the picture at the midday session on the major European bourses. The DAX index down below 1% lower, leading the losses this hour. Well, we're seeing oil climb higher again, back towards that $100 mark when it was around the $70 a barrel mark before the U.S. and Israel started this war. It's a steep increase, but does it necessarily mean it'll translate into a recession, as many are fearing? For more on that question, let's bring in Ilian Mihov. He's a professor of economics at INSEAD, and he joins us now live from Buenos Aires in Argentina. Thank you very much for being with us, Professor. I'll go right into it. What do you see being the impact of this increase in oil prices for economic activity? Is it really just about the price? But what about the wider supply disruption, not just of oil, but a number of other critical products?
Well, first of all, thank you for having me here, Charles. Indeed, it's a very big question, and the effect of the price of oil depends on three things. First, as you say, what kind of shock it is. The price of oil itself, even at $90, $100, $120, I think it can be absorbed relatively well by the economy. In fact, between 2010 and 2014, in today's dollars, the price of oil was nearly 150. But I think that the real issue is the supply disruptions and the shortages that we see in terms of fertilizers, petrochemicals, helium, and so on. If shortages persist, so if this ceasefire turns out to be very fragile, as people call it these days, I think that the shortages will bring some of the economies around the world to a halt, and there'll be stagnation. Imagine that you have your productive capacity, you have your factory, but you cannot use it because you don't have the intermediate goods. And when it happens in one company, then down the supply chain, that will happen in other companies as well. So to me, this is a bigger danger in terms of tilting the economy into a recession.
The last time inflation went up because of an energy shock was in 2022 in the wake of Russia's full-scale invasion of Ukraine. And back then, central banks increased their interest rates to curb those price increases. Is it likely that we'll see that again from central banks this time around?
So the impact of the oil price shock depends also on two other things. One of them is exactly the reaction of monetary policy. I think in the late 90s, Ben Bernanke, the former chairman of the Fed, published a paper with co-authors that basically said central bank, the recessions that we have seen in the past that were right after the oil price shock, because we know that every recession in the United States, at least, has been preceded by an oil price shock, except the COVID-19 one. But the recession, according to Bernanke and co-authors, was due to the rapid increase in interest rates by the overreaction of the central bank. So how the central bank reacts will be very important. And the third part, and that's where the really interesting and complicated story starts, is the state of the economy. When the economy is moving fast and in an expansion, increasing interest rates may not be damaging it too much. But when the economy is actually stagnating, when it's moving very slowly, the rise in the interest rates can be quite damaging and can push the economy into recession, as Bernanke and co-authors were arguing. At the same time, if they don't raise interest rates, of course, you'll see inflation throughout the system. So understanding where the economy is today and by how much to raise or maybe even lower rates is the big dilemma. And the issue is that if you look at the US in the last 9 months or so, there's something really strange happening on the labor market. Every month, we have a number that goes in the opposite direction. One month, we have a positive number, the next month, negative number in terms of job creation. So for the last 10 months or so, it has been flipping like this, with about 5 months out of 10 having negative job creation, that is job destruction.
So you mentioned this job destruction. I'm sorry, I'm interrupting here a little bit. I want to rebound on this idea of the job destruction that's happening while there's still expansion. The labor market is the other huge factor for central banks when they decide what to do with rates and when they fine-tune their decision. What you just described, this labor market destruction that we've seen in recent months, what does that portend when you add an energy shock to the mix?
Exactly. So when you look at the state of the labor market, what we have seen in the last 9 months or 10 months has never happened in the history of the United States during expansion. So during expansions, the economy is creating more and more jobs. Sometimes there could be a negative number, job destruction, but usually it's like one during an expansion or maybe two spaced apart. Only during recessions, we have seen so many months of job destruction. So the labor market is very weak. It is actually stagnating. In the last year or so, the total number of employed people has stayed roughly the same. So when you're faced with this sluggish labor market, when you're faced with this kind of economy, and then you raise interest rates, it's almost sure that we'll end up in a recession or may end up in a stagflation. Because the other side of this equation is that if you look at inflation in the last 2-3 months, we've always received surprises on the upside before the oil price shock. So there is something else going on in the economy outside of the oil price shock that is telling us there is inflation that is still quite persistent. And now with the oil price shock, it may actually accelerate even further. So it's a very, very difficult situation. Weak labor market, low interest rates, higher inflation, oil price shock, raise interest rates. And how to balance this is very difficult.
A delicate situation indeed, Professor Ilian Mihov, Professor of Economics at INSEAD. Thank you for sharing your insights on this very concerning question for all of us about the possibility of a recession in the wake of that war in the Middle East. Thank you for being with us on France 24.
Okay.